There are many ways to invest in real estate, strategies beyond the DIY and the house flipping tactics you may see on TV. The U.S. real estate market is expected to reach $3.8 trillion in the next 5 years. So, how could you tap into that? Well, in this show, Ryan English of Foster Motley will explain some of the options. I'm Patrice Sikora. And Ryan, thanks for being here again.
You're welcome. Glad to be on here.
Let's talk about the potential benefits to investing in real estate. What might some of those be?
Well, the primary benefits would be the potential for increased or higher returns relative to other assets. And another benefit would be diversification. The correlation or the return profile would be potentially different from stocks and bonds.
So, Ryan, what would be considered investment real estate?
That's a great question, Patrice. I mean, it's certainly, there's a broad definition potentially. The main way we would look at it is commercial properties. So think like retail real estate, industrial warehouses, manufacturing facilities, manufactured housing communities, multifamily or apartments, or any sort of portfolio of real estate. A lot of clients own a home, right? I mean, that is an investment in real estate, but not necessarily one we would consider an investment. It certainly could be a good investment, but we would look at a portfolio of single family houses as an investment as opposed to a single home.
So, Ryan, you're saying the DIY shows, the house flipping episodes that we see all over television, that's not the best way to go for real estate?
Well, I mean, you can potentially make money in flipping houses. I think the stats do show that most people don't, but, it's a potential route, not one we pursue.
Well, how much of a part of your portfolio should real estate be?
That depends by client. It depends on their, potential for risk. That depends on how much income they need from the portfolio. That depends on how much in stocks and bonds are appropriate for them, as well as, do they own investment real estate outside of their, publicly traded, stock portfolio? Do they work in an industry that has exposure to real estate? So, all of those factors would go into determining a client's asset allocation, whether real estate was appropriate.
And how does Foster Motley do it for them?
So we do it a couple ways. Number one, the most common way that I think anybody invests in real estate with their portfolio is to invest in publicly traded REITs or real estate investment trusts, where, it trades just like a stock. They're invested in commercial properties, usually by sector. They're typically not broad, encompassing of all different types of real estate. And then the other way we do it is investment in private real estate, where we actually invest in an illiquid structure like a fund, where we find a partner or a real estate professional or expert that, would go out and actually purchase the properties and, ultimately lease them out or sell them and earn a return.
Okay. Let's start with REITs. Tell me a little bit more about those.
Yeah, so REITs, they've been around, I think, since the 70s, and it is a specific structure in the tax code. It's a real estate investment trust. And the criteria is that the company must own or must be invested in at least 75% of their assets in real estate. And then they also, which is the kicker, they must pay out 90% of all of their income in the form of a distribution or a dividend. And so it's a favorable structure from a tax standpoint. So if you're a real estate investment trust, you avoid the double taxation of a typical publicly traded company, which means that a public company would pay taxes at the corporate level, right? An income tax rate or a corporate tax rate. And then once they paid out the distribution, the individual would also pay the dividend tax rate. So if you are invested in REITs, typically this does not happen. Now, all REITs do not, most REITs do not get the favorable 15% or 20% dividend tax rate, though. It can be treated as ordinary income in most cases.
But a REIT would give you access to the real estate market, number one.
Yeah, it gives you easy access. It gives you easy access that you can essentially buy and sell each day the market is open.
Which means it's pretty liquid then, too.
It's extremely liquid.
So what about the private real estate? I would guess that's just not as liquid.
That is not nearly as liquid. And, typically there is an illiquidity premium, as they say. And that is if you invest in something that does not have, daily or market traded liquidity like a REIT, that you should earn a higher return for locking up your money for longer. So there is an extra anticipated return from that illiquidity premium. And then we think about investing in private real estate on on a spectrum of three different things, from lower risk, lower expected return to higher risk, higher expected return. So the first aspect of that would be a core real estate type of investment where we are purchasing something that, is already existing. It's leased up. It's got high occupancy, and a large portion of that return could be from the income you earn. And it's less risky than, say, the middle portion, what I would call value add real estate, where, you're buying something privately and you need to put some money into it in order to earn an anticipated higher rental rate. And so you're making an investment to improve that particular property. And some of the return is in the form of income, and some of the return is in the form of, what you sell it for in the end. And then the higher risk, higher return portion would be the development aspect, where you're doing something from scratch. You're building a particular commercial property. You're leasing it up. You're taking on financing, a lot of financing to build it. And you're taking on risks that ultimately that property will lease up and you can sell it.
Sounds like something that's a little complicated, more like a hedge fund would get into that.
Hedge funds, they are involved in real estate. Certainly, there's a number of them. The real estate market is, considered to be a less efficient market than the stock market as well, right? Real estate is local, and the knowledge that individuals can acquire, can help them earn above average returns based on, what they anticipate or what they see.
All right. What about interest rates, Ryan? How would they impact owning either the private funds or the REITs?
Well, interest rates, can be the friend of real estate, and they can also be the foe, right? If interest rates are increasing in the environment that we've currently experienced, that's a negative for real estate. And interest rates are a very big component in valuing real estate, and they have an inverse relationship, right? The higher as interest rates go up, typically the values of the properties can go down. So it is a big factor in investing in real estate, and something that's, impossible to predict, right? If interest rates were to go down now, certainly there would be a lot of value gained in real estate.
So talk to me about whether real estate is good if there's inflation.
Real estate, that is a great question. Typically real estate is thought of as a great inflation hedge, and it certainly can be. So it has two components to it there. The number one, right, existing structures or existing commercial properties in place, their value is tied to the cost to build a new particular property. So as the cost of new construction goes up, the values of the existing are also going up typically. So inflation is directly impacted by wages, right? Materials costs, and those are in the new construction prices. Also, in real estate, you're leasing something out, and the duration or the length of the lease varies. And also, you can have inflation escalators in a lease, right? So say, there's an office property and an office tenant has to pay a 2 or 2.5% or 3% higher particular rental rate each year. So that is a hedge against inflation. And then you've got, say, hotels, right? They're a form of real estate, and, they can change their prices every day with inflation. So it depends on the length of your lease in real estate and whether or not you have an inflation escalator in there. Those are big factors in whether the particular real estate you're investing in is an inflation hedge.
And I can see this becoming also a geopolitical issue. You just mentioned hotels. If people don't travel, if something happens, weather-wise or politically, people aren't going to travel in your hotel. You can change your prices all you want. People aren't coming.
Right. There's still competitive risks. There's still changing market or preference dynamics in real estate, right? We've seen it in retail with more and more purchases on the internet. That has affected malls, their valuation substantially. That has also improved industrial valuations because there's more distribution centers that are needed because of purchases online. The remote work or the hybrid work for office has impacted office valuations. In particular, the, lesser desired Class B office space. So, there's certainly things that can change and consumer preferences that can affect real estate as well, not just interest rates.
And you mentioned this being a very local type of knowledge. Talk a little bit more about that.
Yeah, investing in real estate, you really need to know the area typically. You think about whether there's location is what they always say, right? There's certainly a lot of resources to evaluate that from a national level, but typically, even the real estate companies that we invest with, they get people on the ground traveling around to evaluate everything in person. And I think that's important. Knowing where a stoplight may go in, knowing where an exit ramp may go in. Those are all things that can potentially be big opportunities for investment in real estate.
All right. And then just one other question for you. Temperament, investor temperament. Talk about how much risk tolerance you really need for this.
Well, certainly it depends what type of real estate you're investing in, right? The publicly traded REITs, they are typically more volatile than certainly bonds, but stocks at times. So you need a little bit higher of a risk tolerance to invest in them. They do provide a differentiated return profile. And so most of the publicly traded stocks, though, they are large companies that have a lot of access to capital. They can issue shares if they were ever to get in trouble in a very liquid market. So, certainly they're like investing in stocks, I would say. On the private real estate side, if you're investing in some stabilized properties, some core properties, that is less risky. If you're investing in development projects, certainly you need a much higher risk tolerance for that particular investment and to be able to right size it relative to your overall assets.
All right, good stuff, Ryan. Is there something we didn't touch on you want to make sure we do?
I don't think so. I think we covered most of it.
All right, then. How can people reach you at Foster and Motley?
Patrice, the best way to reach us is our website, and that's www.fosterandmotley.com, and that "and" is A-N-D.
All right. And as you've heard, real estate is more than just buying a property. If you have questions, the folks at Foster and Motley may have some answers. Contact them. And be sure to follow this podcast and please share it with others. We value your time, and thanks for being with us.